All right, let's go ahead and get this started. My name's Joe Pivarunas. I'm the founder and managing editor of Nanalyze. We're a boutique media and research firm that covers disruptive tech for a broad audience of retail and institutional investors across the globe. Today's presentation is going to be on a company called Schrodinger, and we're going to be dissecting their business model. So, about every year or so, we like to check in with stocks, and we realize that we haven't looked at Schrodinger since they had their IPO. We published a research piece around that time. So, today, we want to look at how they make their money, how things are going for the firm. They make their money in two different ways. First is that they license software to customers. That's mainly on premise. What that means is that they're installing the software on the customer site on customer servers as opposed to having the customer access the software from the cloud. So, why do firms do that? Well, we used to sell enterprise software solutions at MSCI, and a lot of the hedge funds we sold to did not want their portfolios living up in the cloud. So, there are a lot of concerns that firms have around, still to this day, around security in the cloud and whatnot. That could be one of the reasons why firms would prefer to have on premise as opposed to in the cloud. Now, Schrodinger does also offer a hosted solution, but that's a much smaller percentage of their software revenues. Second part of their business model, this is the interesting one. Companies like Ginkgo Bioworks, Abcelera, and Schrodinger, they take this approach where they develop some successful molecule and then they say, look, if this thing's a success, I want a piece of that downstream. And they'll get that through royalties and milestone payments. And they can be very large rewards if a drug is successful. So that's the business model for Schrodinger. If we look at how things are going, so they have their year end coming up. I think it's next month, about a month from today, and they're going to go over the year end results. Now, we wanted to do this in advance of that so that when that happens, we can react to whatever volatility there is and quickly check the numbers to make sure that everything is in line. Now, the financial outlook they gave as of November of last year is that total revenue will come in at a potential range of 124 to 134 million. That on the downs or the bottom side of that, the lower end of that guidance would be 15% increase in revenues year over year. That's okay. Software revenues, you can see here, guidance for that on the lower end of that range is 10%, again, barely clearing the double digits. And drug discovery revenue has grown quite significantly. So we want to examine each of these areas to learn a little bit more about them. So let's look at the software revenues. We say like SaaS, same, but different. So if you're ever on the banana pancake trail in East Asia, a lot of the vendors use this term. So they'll try to sell you like some North Face jacket, and you'll say, "Oh, is it North Face?" They're like, "Yeah, same, but different." So that's how we would describe Schrodinger in terms of the whether or not they're SaaS. So they're similar to a SaaS, but they're different. So SaaS, as you know, software as a service. Firms that operate those types of business models are very easy to follow and track. The market actually ascribes a premium to them. So when we're looking at Schrodinger, top table, software products and services point in time. Now, that refers to these typical 1 year contracts that Schrodinger has with their clients for the software installed on premise, right? And that's paid. They recognize that just at the point when it's paid. So they pay a one time payment for that access. And then after the year contract is over, the customer can decide if they want to purchase it again, as opposed to the sort of recurring revenue contracts a typical SaaS company might have that are 1.5 to 3 years. So that point in time that you see there, the percentage, maps almost exactly to the below table on-premise software, the percentage of that number compared to overall revenue. So that's the way that they license their on-premise software. Then you have hosted software maintenance. As we said earlier, hosted is the cloud software maintenance. That makes sense. And professional services, which is declining. And we're going to talk about that in a second. So those three categories combined, those equal the 28.7% you see in the above table. Then you have the drug discovery, point in time, and overtime. And we're not sure what those look like, because the arrangements that Schrodinger has with their clients regarding royalties and milestones that's information that only they're privy to. So what we want to look at next is the decrease in professional services. Let's say we want to keep an eye on this. And why is that? Because the company defines professional services as training, technical support, installation, assisting customers with modeling, the sorts of things you would do to onboard new clients. So if you see that number decreasing, definitely want to pay attention to this chart, which is provided in the 10K. So they will refresh this in the coming 10K, we would imagine, and provide a 2021 data point. So you can see in the chart, this is the number of customers that had an annual contract value. That's what they refer to their revenue as, whereas SaaS companies call it annual recurring revenue, ARR. Schrodinger calls it annual contract value of at least $1,000 during the year. So somebody's paying them at least $1,000. That's not a lot of money, and you want to make sure that customers are actually paying them money that's meaningful, which means that real decision makers got involved, right? And to look at that, we can then look at some other charts they provide. This gives us net retention rate. So net retention rate is the amount of money that your clients, your existing clients, the ones that aren't canceling, are spending every year. Is it increasing? Well, it should be. That means that either you're increasing your prices or they're spending more money. So ideally, you have clients spending more money. So when we look at customers Schrodinger has that pay them $1 million or more, we see that numbers going up. So we'll look forward to seeing what that is in 2021. While Schrodinger doesn't give us the percentage net retention rate, we can pay attention to these charts and try to gauge it. The next one, this is customers with an annual contract value above $100,000. That's meaningful. And we can see that number growing over time. So we'll want to see that for 2021, that number growing as well. Then let's talk a little bit about drug discovery revenue. So there's a couple concerns we have with this particular segment. First is that they can be lumpy. So, and you can see here for the last 4 years, there's a little bit of a trend there. So this will then come in at, what did we say for 2021? The estimate for drug discovery is a range. So let's say it comes in at 22. So you'll see that's significant. So that'll be a nice trend. So for all practical purposes, the sort of lumpiness we're talking about is where it suddenly becomes non-existent in any particular year. So this is actually pretty good. The other thing we look at is that the valuation of the company isn't impacted by these promises of riches down the road. That's what you see with Ginkgo Bioworks. So if you remove the promises from their valuation, along with related revenues and their COVID stuff, you get a very richly valued firm. So we can do the same thing for Schrodinger. We use our simple valuation ratio. This is market cap divided by annualized revenues. The first number here, this is their market cap divided by annualized revenues, that Q3 2021, we multiply that by 4, and that's the number we get, 16. So 40 we consider too high. So any firm that has 40 or higher, it doesn't matter what the growth story is or what's happening, we're just not going to invest in it. It's too rich. 20 would be middle, and maybe it's hard to say what low is because you really need to do a relative comparison. So for example, Ginkgo Bioworks right now is 29. That's with COVID revenues and related revenues included. Okay, so you can see that if you just use that simple comparison between these two firms, that Schrodinger is not as excessively valued as Ginkgo Bioworks. Then what we can do is we move the drug discovery revenues, and it's at 19. So anything in the middle there around 20, it's hard to argue it either way. Is it overvalued, undervalued? You could probably argue it either way. But the point is that it's not excessively overvalued, and we don't believe their downstream potential is being overly valued in today's share prices. And by the way, Schrodinger has been falling quite a bit since their IPO. So the other thing that's worth noting is some of the comments the CEO made in their last earnings call, and analysts had indeed raised questions around the health of the software business in terms of its growth capabilities. And the CEO verbatim said that customers require significantly more licenses than what they have access to now. In other words, if the solution works for them, it does what it says on the tin, then they're likely to expand. And he was saying that ideal penetration in the range of $30 or $40 million per company in terms of the clients that they have on board, potentially higher for their bigger clients. And then regarding retention rate, Schrodinger has had a great retention rate, high 90s. He said they expect to maintain its long, historic, extremely high retention rate, and they hope to achieve very, very high 90s going forward. So what's very, very high 90s? Let's say 98, 99. So that's great to hear. And that's a number they report that we're going to want to pay attention to. That's gross retention rate, which means the number of clients that after that 1 year comes up, they leave. So let's say they stay, right? So 99% of clients, when they had that 1 year contract come up for renewal, they renew it. Okay, that's great. Now, there are two other things we wanted to mention about Schroeder of interest. And the first is their relationship with Bristol Myers Squibb. They're one of the biggest pharma companies in the world, and they announced a relationship with Schrodinger. Here's how it works. Schrodinger is going to develop molecules for them at their own cost for up to 4 years' time. Bristol gave them a $55 million upfront payment, and it appears that they're recognizing that. So Schrodinger's recognizing that as revenue over the years. So this last quarter, they recognized 4.4 million, I believe, out of like 5.6 total. So a good chunk of their Q3 2021 revenues from drug discovery were from BMS. So they have that upfront payment. And then the real potential value is the $2.7 billion that they can potentially reach in milestones across all potential targets that they're investigating. Now, it's critically important that this succeeds, not only to capture some of that cash, but to show the platform works. Because if they go into this arrangement with BMS and they come out of it without anything, what are their other clients going to think? So this is a very visible and important relationship that we're going to keep a close eye on. Not only that, Schrodinger stands to gain a tiered percentage royalty on annual global net sales. Now that's going to require successful commercialization of whatever molecules they develop. The other thing that happened recently, and this is what made us look at Schrodinger again, reminded us, was their acquisition of this company called XTAL Biostructures. We recently did an article, and I'll put it in the description so you can check it out. Did a piece on a firm that's developing a particular type of microscope and using that for drug discovery. We looked at structural biology and this technology called X-ray crystallography. Now, I'm not going to get into the technical details because I don't understand them myself, but very simply, it's the ability to examine proteins with a high degree of accuracy. So we know, like DeepMind's AlphaFold, they're now predicting proteins. Well, what's ground truth? Well, you can use X-ray crystallography to evaluate a protein structurally, so you can truly see what it looks like. And that's one of the things that XTAL Biostructures does. What Schrodinger made a remark was very interesting. They said, we want to have that finer resolution. We want to feed that to our platform. So their AI algorithms in the platform then crunch that and presumably make predictions on it. Well, guess what? The higher resolution data that you feed a AI algorithm, the more accurate the output's going to be. So this was an interesting acquisition. They only spent 6 million. I think Schrodinger has around 600 million on their books right now, so they have plenty of cash, and they spent 6 million on this. And then to conclude, so the basic metrics appeared healthy up until last year. So we'll look forward to their year end. We'll take a quick scan through that 10K, verify some data points, make sure nothing looks alarming. And it appears that there's a lot of potential with the drug discovery business, and it's not being overly valued from what we can see. And I think if there's no red flags raised in their year-end results, we may look to add some shares. Now, what we've been seeing a lot of, I'm sure you've been seeing it as well, firms that have pretty strong or even good results that they announce, and the market takes a dump because the expectations are just so high these days. So we're certainly going to be keeping an eye out to see what sort of volatility happens around March 3rd or 4th, right? Can't recall the exact date, but that's something to keep an eye on. So Schrodinger, very interesting company using AI and what they call physics-based computational modeling platform to develop molecules that have a better chance of passing the FDA drug approval gauntlet. So very interesting firm. Please make sure to subscribe to our YouTube video, and we'll be putting out more videos about exciting firms like Schrodinger and space stocks and bio stocks, things like that. Thank you very much for your time.